If you're interested in stocks that could deliver serious long-term gains, well, you've come to the right place. Today, I'm sharing my top 10 stock picks with tremendous long-term upside potential. Each one has a solid investment thesis and robust growth potential. Be sure to stick around to the end because I'm going to unveil a bonus stock I'm kind of obsessed with. I just added it to my Zen investor portfolio because few stocks have as impressive upside potential in the coming year. It's overlooked by a lot of investors, but it's one of the best businesses hiding in plain sight. But don't skip ahead because there's a lot of great stuff coming with the first 10 stocks. By the way, I'm Steve Reitmeister. I was the editor-in-chief of Zacks.com for over a decade, and I'm currently a partner at WallStreetZen.com. After 4+ years investing, I am confident that nothing beats a focus on fundamentally sound companies. Don't be mesmerized by price action, which is a lot of noise and nonsense. Consistent growth plus strong financials plus reasonable valuations always has been and always will be the best path to consistently beat the market. The stocks I'm talking about today aren't the typical names you'll hear on CNBCs. We're not going to talk about Tesla or NVIDIA or Microsoft. Most of these stocks score in the top 1% of the stocks we track based upon fundamental strength. That's not hype, that's just sound data. If you want more stock picks backed by real analysis instead of whatever's trending on social media, hit that like button right now. It tells me to record more videos like this in the future. All right, let's start our countdown with stock number 10, and that's going to be UMA with a symbol of OOMA. Yeah, so this is a phone system stock. Not so sexy on the surface, but here's what will get your heart racing. Over 70% projected share price upside potential. Here's the deal. Small businesses are finally ditching their ancient desktop phones and moving to cloud-based communication systems. UMA has built a platform that combines phone service, video conferencing, and collaboration tools into one simple package designed specifically for the small and medium-sized business market, which we often call SMBs. They're not trying to compete with Zoom for enterprise customers. They're going after the local dentist office, the law firm with 3 partners, and the boutique retailer that just needs something that works and something that fits their much smaller budgets. The pandemic accelerated cloud adoption by 3 to 5 years. Businesses that were planning to upgrade eventually were forced to do it in 2020 and 2021. By now, they need modern solutions, and UMA's positioned as the affordable, easy-to-implement option that doesn't require a strong IT department. The business model is subscription-based, generating recurring revenue with high gross margins. Once UMA gets a customer on board, the lifetime value is substantial because monthly fees compound over the years. And the SMB market they're targeting is massive and underserved. UMA actually ranks in the top 1% of stocks we track in our quant system known as the Zen Ratings. It's also great to note the love flowing from Wall Street where they have 100% strong buy ratings. On top of that is an average price target that suggests over 6% upside from current levels, whereas the street high target suggests over 70% upside potential. The risk? The C grades on momentum and safety tell you the stock hasn't captured an investor imagination just yet. Competition in cloud communications is intense. You got Microsoft Teams, RingCentral, Vonage, and profit margins can be challenging as they invest in customer acquisition. But here's the thing. Boring businesses often make the best investments. While everyone's chasing the next shiny object like AI, companies like UMA are steadily growing revenue, expanding margins, and compounding shareholder value. With analysts seeing 6% or more upside, this is a grinded-out compounder where the business steadily improves and the stock price eventually follows. Moving on to stock number 9, which is Taylor Devices with a symbol of TAYD. Buildings are getting taller, infrastructure is aging, and climate-related disasters are becoming a bit too frequent. This is why engineers design modern structures that can withstand earthquakes, high winds, and heavy vibrations. As such, they need to turn to specialized dampening systems. Enter Taylor Devices. Taylor manufactures the shock absorbers and seismic isolation systems that protect everything from skyscrapers to bridges to military equipment. This stock has already run up hard, up over 100% the past year. So why am I still sharing it with you today? Because the move may be far from over. TAYD ranks in the top 1% of stocks in our quant rating system. It's actually rated in the top 10 of over 4,600 stocks we track. The component grades also tell a compelling story. A for momentum, B for growth, and B for financial strength. What's driving these shares? How about the 3-year average earnings growth rate of 120%? Yes, on average, the company has more than doubled its earnings every year for 3 years running. The balance sheet is very strong. Its debt-to-equity ratio is a minimal 0.9, which means the company is essentially unlevered. In a cyclical industrial business, having little debt is a massive competitive advantage. Insider conviction is strong too. There have been several recent insider purchases. The CEO and directors are buying stock even after the big run-up. Few signals in investing are as potent as this kind with insider buying. Okay, the risk? Well, after a stock doubles in a year, you have to expect some consolidation or maybe even a little bit of a pullback. Plus, this is a smaller company with project-based revenue that can be lumpy, and the C grade in safety suggests more volatility than a larger industrial company. But here's the bottom line. When you're the specialist in something as obscure as earthquake protection, you don't have much competition, which leads to market leadership, which leads to higher profit margins. This isn't a flash-in-the-pan concept. It's about earnings momentum begetting price momentum, a party that typically lasts for quite a while. Next up is stock number 8, which is TIM-SA with a symbol of TIMB. TIMB is the third largest mobile carrier in Brazil, operating in a country where smartphone penetration is still growing, 5G rollout is accelerating, and customers are increasingly dependent on mobile data from everything to banking to entertainment. The Brazil-based risk is real, but it's also priced in. Emerging market telecoms trade at massive discounts to their developed market peers, even when they're growing much, much faster. Once again, this stock ranks in the top 1% of all the equities we track in our AI-driven quant model. Looking at it more granularly, the component grades, one thing that really stands out is the A rating for financials. For an emerging market stock, having top-tier financial strength is truly a remarkable achievement. The telecom oligopoly structure in Brazil is also attractive. 3 major players control the market: Vivo, Claro, and TIM, and the barriers to entry for a fourth competitor are astronomical. This creates pricing power and stability you don't typically associate with emerging markets. Plus, you're getting a 3.7% dividend yield. Even the stock goes nowhere, you're collecting healthy income. Gladly, there's great reason for optimism for the future share price appreciation given their ample growth prospects. The risks are obvious. You're buying a Brazilian company. That means currency risk, political risk, regulatory risk. Brazilian telecom regulators can and do impose requirements that impact profitability, and the competitive intensity can be brutal. Here's my take. This is an emerging market value play for investors who want diversification beyond U.S. equities. You're getting a profitable, dividend-paying telecom with top-tier financial strength. It's trading at a discount because it's in Brazil. That's exactly the type of mispricing that creates long-term opportunity. Number 7 is Perma-Pipe with a symbol of PPIH. Every single politician in the world is talking about infrastructure spending, not just roads and bridges, but energy infrastructure, industrial facilities, and district heating systems. PPIH makes the specialized piping that goes into these kind of projects. More specifically, insulated pipes, leak detection systems, and engineered piping solutions for extreme environment. The global infrastructure build-out is just getting started. Between the U.S. Infrastructure Investment and Jobs Act, Europe's green energy transition, and Middle East mega projects, there's a decade-long wave of spending on the way. What makes this opportunity interesting is the specialization. This isn't commodity piping like you get at Home Depot. These are specialty engineered systems for district energy, oil and gas, and industrial applications where failure is not an option. Just like the other stocks, it has a Zen rating of A and ranks in the top 1% of all the stocks we track. The component grade showed solid B ratings in several key areas like growth, sentiment, and financials. These top ratings generally increase the odds of more earnings beats and share price appreciation ahead. The revenue growth trajectory is compelling, over 15% annually over the past 5 years. That's consistent, sustainable expansion driven by long-term project wins. The insider activity is encouraging too, with recent buying from key executives. Their geographic diversification is underrated. They have operations in North America, the Middle East, and other key regions, thus reducing dependence on any single market. The risk, I do look at the C grade for the safety rating as a mild yellow flag. The project-based revenue model creates lumpiness. Quarterly results can swing based on the contract timing, and last year's earnings growth was actually a little bit negative, showing that not every year is going to be a winner. But here's why I like it. This is how you play energy without taking the risk of drilling a single well. well. Instead, you are the key supplier to those who are taking on the risks of these massive infrastructure projects, what is often called a pick and shovel play, or in this case, pipes play. Here's another favorite stock of mine coming in at number 6. I'm talking about U.S. Foods with the symbol of USFD. Here's a business model I appreciate. A company that sells products people need regardless of economic conditions. Its resiliency is one of the reasons I added to my Zen investor portfolio. You can scan the QR code to see more of my private stocks and the coveted picks in the Zen investor portfolio. Whether the economy is booming or there's a recession in the air, people still need to eat. That's the kind of stability I want in my portfolio. Not long ago, USFD took a nasty haircut after reporting stellar earnings, a classic case of price action telling a false narrative about the company. Gladly, the fundamental attractiveness of U.S. Foods is winning out, with shares quickly bouncing back and then some. Speaking of earnings, the company delivered its 8th straight beat and raise quarter. Great combination of revenue growth, earnings growth, and improving margins, meaning they are firing on all cylinders. So why did it drop after last beat? Simple. Shares had rocketed nearly 6% since June of 2024. Some investors had unrealistic expectations and used the news as an excuse to take profits off the table. But this is a classic case of 2 steps forward and 1 step back in action. The fundamentals didn't deteriorate. Traders just took money off the table. Wall Street's top analysts certainly aren't backing away. USFD has 5 strong buy ratings right now, with several top-rated analysts projecting double-digit growth in the coming year. The Zen Ratings shows several hardy B grades, not just for the overall score, but for the key component grades like growth, safety, and financials. The company is showing consistent growth across multiple metrics, not just earnings, but revenue, cash flow, EBITDA, and profit margins. These are proven signs that often point to more earnings beats ahead. Now, the risk, economic sensitivity. Restaurants feel the pinch first during recessions. The food distribution business is also fiercely competitive with constant margin pressure. But here's what I like in these shares. 8 consecutive beat and raise quarters tells me that management team knows how to execute. We're getting a chance to buy quality earnings at a discount because of a short-term profit taken, with analysts seeing ample upside potential ahead. Quick pause. If you're getting value from this stock breakdown, then do yourself a favor and hit subscribe. That's because I put out fresh picks like these regularly, and you don't want to miss out in the future. Okay, we've covered 5 solid stocks so far, but now we're getting into the top 5, and this is where things get really interesting. Let's keep the party going with number 5, which is Deluxe Corporation with a symbol of DLX. Small and medium-sized businesses are drowning complexity. They need payment processing, market automation, fraud protection, and back-office infrastructure. But no one wants to cobble together 10 different vendors to get it done. DLX has quietly transformed itself from a check-printing dinosaur into exactly the kind of integrated business services platform these companies are desperate for. The market still sees them as the old Deluxe, the company your grandmother used to order checks from, but that business now represents just a small fraction of their revenue. They've pivoted hard into merchant services, data-driven marketing, and cloud-based business solutions. The rebrand hasn't fully registered with Wall Street yet, but once it does, shares should be really off to the races. Its Zen Ratings is exceptional. Not just A-rated, but actually the top 0.15% of all the stocks we track. The standout component here is for growth. This makes perfect sense when you understand they generated 48% earnings growth last year. In an environment where most mature companies are struggling to post mid-single-digit growth, DLX is putting up numbers that look more like a software startup. The business model has high switching costs. Once a small business integrates DLX's payment processing, fraud tools, and marketing platform into their operations, the pain of ripping it all out and moving on to competitors is substantial. This creates customer stickiness and healthy recurring revenue. They're riding 2 powerful secular trends: the continued digitalization of small business operations and the shift away from cash transactions. Both are decade-long tailwinds. They're riding 2 powerful secular trends: the continued digitalization of small business operations and the shift away from cash transactions. Both are decade-long tailwinds. The valuation is also part of the excitement here, as it's in the top 10% of all the stocks we track. Again, the street continues to think of them like the old Deluxe with the printed checkbooks, not the software growth story it is now. The risk, competition, merchant services, and small, medium-sized business software is brutal. You got Square, Stripe, Intuit, and more. There's also execution risk around the business model transformation. But here's my take. Everyone thinks checks are dead, so they write off the whole company. Meanwhile, Deluxe is quietly building a payments empire using the cash flow from their legacy business. The 48% earnings growth isn't a fluke. It's the early stages of a business model shift that could sustain ample growth and share price appreciation for years to come. Okay, moving on to number 4 in Millicom with the symbol of TIGO. While U.S. telecom is saturated and boring, Latin America, which we already touched upon earlier by TIMB, is in the middle of a massive telecom infrastructure upgrade cycle. These markets are going from 3G to 4G or 4G to 5G, and in some areas, connecting people to the internet for the very first time. TIGO is the picks and shovels play on this transformation. They operate across 9 countries in Latin America and Africa, most notably Colombia, Guatemala, Panama, Bolivia, and Paraguay. Once again, it has a Zen rating of A and ranks in the top percent of stocks we track. But the number that jumps off the screen to me is the earnings growth, and that's over 600% year over year. Obviously, that's not a sustainable pace, but it shows you the operating leverage in their business model. Out of the 3 analysts we track for the stock, 2 of them rate as a strong buy with ample upside projections on the share price target. That's because the infrastructure moat here is significant. It's incredibly hard and expensive to replicate telecom networks. Once TIGO has built out their networks in a country, they've created a durable competitive advantage. As these economies digitize and more people get access to smartphones and broadband, TIGO essentially prints money off the infrastructure they've already built. And at just 3.1 times price to book, despite this growth profile, the stock looks incredibly undervalued. On top of that, this one is solid across many of the component grades, with mostly Bs in most categories, but the most impressive is the A for sentiment. What are the risks? Well, we're dealing with the same things that we talked about with another pick in TIMB. Emerging market exposure means foreign currency risk, political risk, and regulatory risk. Telecom infrastructure plays run with high debt levels, and while long-term revenue growth has been strong, they actually had negative revenue growth of around 4% last year. But here's the math. Latin America is rapidly becoming mobile first, and Millicom owns the infrastructure. As these economies grow, data consumption grows, and it's not hard to do the math and see how that compounds over the next 5 to 10 years. That's a powerful investment thesis. Moving on to stock number 3, which is Nature's Sunshine with a symbol of NATR. The global wellness industry isn't just growing, it's exploding. Everyone from your yoga instructor to your accountant is talking about supplements and gut health and natural remedies. NATR sits right at the sweet spot where these 3 things come together. The natural products movement, the preventative health obsession, and direct-to-consumer sales models. They sell herbal supplements, vitamins, and personal care products through a direct sales model with over 550,000 distributors worldwide. Despite all these growth tailwinds, Nature's Sunshine trades in an absurd valuation discount. How about its Zen ratings, you ask? Well, once again, it's an A-rated, but that only implies it's in the top 5% with over 200 stocks making that grade, whereas this stock actually has the overall highest score. Yes, overall highest score on our A list. This is rarefied air indeed. When you dig in the component grades, it also scores A's for growth, sentiment, and financials. These impressive grades are a big part of why this is one of my favorite stocks and inside my Zen investor portfolio. Nature's Sunshine is sitting on a $470 million revenue base, growing at over 40% annually going back the past 3 years. This also comes with expanding profit margins. This all helps explain the explosive long-term earnings growth, where that has averaged nearly 80% going back the past 3 years. The catalyst is international expansion, particularly in Asia. They're growing fast in markets where wellness products are just hitting mainstream adoption. Yeah, last year they had a temporary dip with earnings down about 5%, but when you zoom out and look at the 3-year trajectory, it's unmistakable. This is a consolidation before the next breakout. The risk, well, the C grade for safety means volatility. This is not surprising for a smaller stock with a market cap under $500 million. Plus, there's regulatory risks and supplements where the laws could change. Plus, there's the multi-level marketing sales model, which carries a little bit of a stigma that keeps some institutional investors on the sidelines. Here's my key take. This is one of the most undervalued stocks on our radar. The fundamentals are stellar and the growth is very real. Wall Street isn't paying attention because it's a small cap direct sales company. That's exactly why it's an exciting opportunity, right? A hidden gem. Moving on to stock number 2, which is Ironwood Pharmaceuticals with a symbol of IRWD. Full disclosure, I avoid many pharma stocks. The industry is full of landmines, but Ironwood is a bit different. Here's what I really like about this setup. Healthcare is defensive. Biotech as a sector is beaten down, and Ironwood is one of the rare biotechs that's actually profitable with proven commercialized products. That combination is incredibly hard to find. Their a GI-focused pharmaceutical company with the commercial products already on the market generating real revenue and profits. They've already done the hard, expensive part of developing and getting FDA approval. Now they're entering the harvest phase where development costs decline and profit margins increase. Of course, their Zen Ratings smiles on the stock with an A rating. In this case, we're talking about one of the top 1% of the stocks we track. But what really blows me away is when you look at the component grade. This thing is A-rated across value, momentum, and financials. That is a near perfect storm. Wall Street has a buy consensus with increasing conviction. The average price target suggests more than 36% upside from current levels, but the max target price suggests about 67% upside potential. That's why it really should catch your eye. The revenue base is solid at over $840 million with consistent growth, and unlike most biotech companies that are hemorrhaging cash, Ironwood is actually making money right now. They're focused on the gastrointestinal space, which is a large and underserved market with an aging demographics as an important tailwind. What you're getting here is essentially a biotech company with a risk profile of a mature pharmaceutical company. They've de-risked the biggest fear in biotech investing, that being the question mark about whether their drugs will actually work or get approved. That's already happened. So what are the risks? You got the C grade for safety, which tells you the stock is volatile, and that kind of comes with the biotech territory. As a small cap biotech, one negative trial result could crater shares, and patent cliffs and regulatory risks always loom for all pharmaceuticals. But here's my key takeaway. If you want exposure to biotech, but you're tired of binary all-or-nothing bets on clinical trials, Ironwood gives you a safer way to play the sector. You're not paying a sky-high multiple for hope and dreams. You're getting a profitable business at an attractive price with excellent upside potential. Now, we finally made the stock number one, which is Betterware de Mexico, with a symbol of BWMX. While everyone in the United States is obsessing over AI, something fascinating is happening south of the border. Latin America is building its own consumer revolution, and most American investors are completely missing out. Think Tupperware meets Amazon affiliates centered in Mexico. They sell home organization products, kitchenware, and household goods through a network of over 500,000 independent distributors. Mexico's middle class is growing. Household formation is accelerating, and their direct consumer model is recession resistant. Distributors earn income by selling products door to door, which actually becomes more attractive during economic downturns. With a Zen rating in the 99.96 percentile of all stocks we track, it's actually the second highest rated stock on the entire list. Wall Street analysts are screening from the rooftops with 100% strong buy conviction. The average price target also represents over 30% upside, but the street high target suggests over 60% upside to reach fair value. That's the kind of asymmetric upside you want in a small cap stock. Now let's talk about the fundamentals. The company scores an A for financials. Return on equity is over 85%, literally 4 times higher than the level recommended by Warren Buffett, meaning that Betterware is a cash-generating machine. Revenue growth is nearly 80% annually over the past 3 years. That is a torrid pace that would make an AI company blush. The risk, well, the safety grade comes in at a C once again, meaning this stock will be volatile. What do you expect from a small cap stock based in Mexico? The currency risk, the peso versus the dollar, will affect quarterly results, sometimes negatively, sometimes positively. But here's my take. When you have 500,000 people actively selling your products, you've got distribution power that e-commerce can't easily replicate, especially when we're talking about Latin America. This is a capital-light, high-return business that compounds beautifully over time. And Wall Street barely covers it because it's a Mexican small cap. That mispricing of shares is our opportunity, with analysts seeing 6% or more upside in the year ahead. This is a compelling risk-reward profile. So, how did I find these 10 sensational stocks? Let me pull back the curtain to share the following. I don't chase trends. I don't follow the herd. I hunt for value where others aren't looking. I use 3 vital criteria. First, fundamental strength. The numbers don't lie. Second, undervalued. I want to buy dollars for 50 cents. Third, growth catalysts that help unlock that upside potential. There is no logical or sane way to do this one stock at a time. This is why I rely upon the Zen Ratings to do the heavy lifting for me. Remember, the Zen Ratings is a quantitative model that analyzes 115 different factors across every stock: growth, value, momentum, financial strength, sentiment, and even AI-driven signals. Notice how several of the stocks today were in the 99th percentile, the top 1%. That's not luck. That's fundamental excellence identified by a systematic process. You can check out any of these stocks yourself at WallStreetZen.com. I use it daily to monitor these positions, track changes in the ratings, and find new opportunities. It's how I stay disciplined. It's how I avoid emotional decisions, and it's how I consistently find stocks the market has overlooked. Please note that I use the same Zen Ratings system to identify 3 stocks that could easily double in 2026. If you'd like to check those out, I'd also put a link to the free report that covers them down in the description. Now, today, we certainly talked about 10 great stocks, but remember the start, I promise you one bonus stock I'm kind of obsessed with. I've been tracking it for months, studying it, waiting for my entry point, and recently I got it and added it to my Zen investor portfolio. It's already up 80% since I added it just 2 months ago. Normally, that kind of quick gain would be a caution sign to new investors. But let me tell you what's so special about the stock and why there is still so much more upside potential to come. The stock is Micron Technology with a symbol of NU. You know, everyone's obsessed with NVIDIA when it comes to AI chip stocks. And look, I get it. NVIDIA has been an absolute monster with the share price rallying for years and years. But here's what most investors are missing. NVIDIA is not the only chip stock benefiting from the AI revolution. While NVIDIA makes the processors, Micron makes the memory chips that power AI systems. And we're hitting an inflection point where AI data centers are consuming memory chips at unprecedented rates. Here's something that gets me fired up. 16 analysts rate it as a strong buy, and 7 of them recently raised their estimates for Micron, even without a new earnings report in hand. When you see that kind of coordinated analyst action before earnings, it's a massive buy signal. The smart money is clearly positioning for continued strength going forward. Check this out. The Zen Ratings are showing its top 5% overall, an A-rated stock, top 20% of growth, over 100% year-over-year earnings growth, top 14% for financial strength, rock-solid balance sheet, top 11% for sentiment. Wall Street is taking notice, top 7% for value, even after the recent 80% gain, right? This is why the opportunity still exists, and top 4% momentum. The train is leaving the station. Now, let's talk about earnings growth. This is pretty interesting. NVIDIA, which trades at a forward PE of 39, reported very impressive 60% earnings growth last year. Micron is expected to grow earnings, check this out, 300% year over year and only has a forward PE of 12. Better growth than NVIDIA, better value than NVIDIA. And gladly, Wall Street's top analysts are seeing exactly what I'm saying about Micron. Kevin Cassidy of Rosenblatt, who ranks in the top 1% of all analysts for his stock-picking performance, he recently doubled down on his $500 price target. However, I think that will prove to be light when you consider their earnings momentum run combined with a still low PE. 600 plus is easily in the cards as we look forward the next year. When I see growth and value packaged together like this, then I'm backing up the truck. Now, let me be honest about the risks. Semiconductors are notoriously cyclical. Memory chip demand can swing dramatically. We've seen Micron go through some brutal down cycles before. Now, there's also the tariff stuff. Micron has manufacturing spread across multiple countries, which provides some flexibility, but semiconductor tariffs could still impact margins if the rules change in the future. And competition is fierce. Samsung and Hynix are formidable competitors in the memory space. But here's why I'm still bullish. The AI revolution isn't a one-year story. This is a multi-year demand supercycle. And Micron's diversified manufacturing base actually provides more tariff flexibility than most of its semiconductor peers. That's why I recently added it to my Zen investor portfolio. Now, I'm not saying you should copy my exact strategy. This is based upon my risk tolerance, my portfolio, my timing. But if you're looking for a methodical way to find great opportunities like this, then start with the Zen Ratings. It's free to check out at WallStreetZen.com. No credit card, no gimmicks, just fundamentally sound data help you outperform. You can pull up Micron right now and see the same analysis I'm looking at and any other stock that strikes your fancy. Okay, there you have it. 10 great stocks. Well, actually 11 with Micron. All fundamentally sound, all trading below fair value, all great opportunities for those who act soon. These aren't get-rich-quick plays. These are multi-year wealth compounders, companies with sustainable competitive advantages, recurring revenue models, and management teams that know how to allocate capital efficiency. Which one of these stocks was your favorite? Please leave a comment below and let me know. And if you like these high-potential stock picks, you'll love my next video about 3 stocks I believe could lead the next wave of AI.